Joining me is Bart Smith from Performance Trust, head of risk and regulatory insights, but also a kind of legend in the regulatory space. You were a 25-year veteran of the FDIC.
That's right.
Bart, thanks for being here.
Yeah, my pleasure.
Tell us about your experience and also your kind of firstly, before we get into the stablecoin stuff, which I know you're excited about and so am I,
Right.
from the perch at Performance Trust, local institution here, a community bank-driven institution. Is there something in Tradfi that is interesting to you, or is this all about thinking about the digital future?
Well, there's always interesting things in Tradfi. And at the moment, though, we're kind of in a sleepy state. Actually, over the last quarter, net interest margins were up, earnings are up, everything seems to be fairly stable. Everybody thinks a CRE crisis is on the horizon. It's not happening.
They've been saying that for a while.
They've been saying it for a while. It just continues to roll around. And then we've got this sleepy stablecoin, which truly is a massive threat to the industry. People discovering in the moment. So I think we're in a stable environment from traditional finance. Generally, performance is a little lower than it has been historically, but a decent environment for banks to feel good about.
I'm interested in this conversation because I'm a bit of a crypto cynic still, but
okay.
Mostly when it comes to sort of the pure speculative nature of some of these things and if they are what people say.
Yeah.
When it comes to stable coins, I think your perspective is interesting because you're not a crypto person pumping a crypto concept.
No.
You're more someone coming from the perspective of looking at a financial institution and defending your moat and wanting to stay ahead of it.
That's exactly right. There's two camps in the stablecoin world. One is this is cross-country payments. This doesn't have anything to do with traditional finance. I'm not concerned about it. The other side is the crypto enthusiast, right? To them, this is the end of banking as we know it. I think we sit somewhere in the middle. And I think what banks need to think about is really, hey, where does this impact me? How does this impact me? Is it something that's real? I think it is real. Personally, I think it is a threat. I think it could be a threat if not dealt with appropriately. And we'll see how it goes. And you got to remember, in the United States, we don't have a couple banks. JP Morgan, Bank of America, Citibank, they're all going to be fine. We've got 8,000 banks and credit unions that are less than 10 billion in assets, community-type organizations. This is a serious issue that they are going to have to contend with over the coming months.
Does that mean, is that a scale thing where if you don't have the massive scale of the biggest money centers that you have to make sure you stay more nimble?
Right. Well, JP Morgan has been exploring this for years. They're coming out with the JPM coin. Bank of America is looking into it. They have the money and infrastructure to go at this full board, take on any kind of new entrance into the system. Smaller community banks are just finding out about this. They certainly don't have the infrastructure to take it on independently. So they're now trying to figure out, hey, how is this potentially going to impact me? And what can I do to kind of stave it off going forward?
Has the Genius Act kind of pushed this forward? How does that timing relate to your experience as a regulator for 2.5 decades?
Yes.
What kind of brought this to you? Was the Genius Act saying, okay, now you have to kind of think about this, or were those wheels starting to turn and you saw them turning from your perch before?
Well, for me, no. If you'd go 12 months ago, all the crypto banks were being shut down. Crypto was a dirty word, and it was associated with Bitcoin and kind of those central cryptocurrencies we're familiar with. Stablecoin's an entirely different thing. It's a payment process. It's a different kind of payment process because it's a different rail, and it's a better rail. And so there's opportunity there, particularly for consumers and everybody who might engage in this activity. But it is a different environment, and banks do have things that threaten because of it.
If you think about some of the main verticals of profitability for banks, in particular fees and those rails, which are the ones most vulnerable to disruption?
Well, no doubt, payment rails and payment income, non-interest income that banks receive is on the table. There's no way in the world that is going to remain high. It's going to go down. That's where their biggest immediate vulnerability is. But the bigger vulnerability is what happens to deposits, particularly in the Genius Act loopholes. There's an ability to potentially pay interest on deposits at bank hold that they don't pay interest on. So you start creating that competitive setting, and you start having deposits move out of the banking system into these other, kind of financial vehicles. that is a huge problem that banks need to deal with. So on one hand, you do have the fee income. On the other hand, you have deposit disintermediation, which is huge. At a minimum, it's going to increase deposit costs in some respect.
As we think about disruption, one of the other themes is AI. I consulted the AI. I want to see what your thought is on what our AI told us. Let's look at it real quick.
Okay.
The question was public adoption of stablecoins more likely to create friction or opportunity for America's biggest banks.
Yep.
And the ICTV AI said stablecoins create friction only if banks defend the old checking account and interchange models. They create opportunity if banks reframe them as programmable deposits, balance sheet efficiency tools, and data-rich trust anchors. The edge isn't in crypto hype, and you kind of mentioned that. It's in who controls the rails. So does each bank have to build a new rail? What's your reaction to that?
No, you build the currency and you put it on a rail. And I think in reality, the technology is going to shift where a guy's got money in a checking account. If he wants to pay somebody with a stable coin, he immediately buys it. It moves to the person he's trying to pay. It's very seamless and transparent for that end consumer perspective. But at the moment, there's not an incentive for you and I to engage in stable coins. We can go on Amazon and purchase anything with our existing credit cards. We don't care. But the merchants and the vendors, those who benefit from lower exchange fees, are going to be pushing this. And that's where I think we get this convergence. And so
you see it's coming from the vendors and the merchants first, which is a very interesting point.
Well, they're the ones who are going to benefit from it, right? If I'm a grocer with a 3% margin, and I can double my margin with getting rid of interchange fees, there's a huge incentive for me to get my customers to use that. So I think in the coming years, I don't think it's months, but in a year, a couple of years down the road, technology is going to catch up. And the merchants are going to push it. Walmart and Amazon, are sitting there thinking about issuing their own coin. Why are they doing that? Because there's so much benefit from it. So I think over time, banks have to react to that. I think they can in providing the payment rails, and I think they'll be competitive in that. The larger banks on their own, the smaller banks with, service providers. But the question comes down to the deposit structure. Can they hold the deposits? And our interest rate's going to go. A Clarity Act comes out. It's going to come out in not too distant future. And with Clarity Act, everything is tokenized. Everything is digital. So the movement and transfer of assets and liabilities is a lot different than it is today. When that happens with the technology around it, now you have a system that is very, very competitive to what has been kind of glued in traditional banking.
It sounds, there's a lot, unfortunately, this is a conversation that's going to go further than the time that we have, but it sounds like when you frame it that way, especially when I come from the merchant and the vendor side, if they can make transactions cheaper and they can make profits better, then that means in theory, they could also reduce prices to some extent, which means higher volume of spending, everybody wins. Is this effectively a stimulative act if realized the way you envision it? Is this an economic macro stimulus if it works out?
I don't know that it's a macro stimulus. It's certainly something that changes the way people pay for activities. In some ways, it could be a macro destimulus because if deposits flow out, you don't get the money supply multiple that you get from banks lending money. And so that's where I think there's a problematic position with this as we extend it down the road from a broader economic perspective. But you're right. We're unpacking a lot of things.
That was kind of going off. The last part then that's a little bit more imminent from the perception is when the number one stable coin is Tether, and you have still guys like Zeke Fox, who are some of one of the best journalists I know, wrote a whole book basically questioning what their deposits are equal to. Could you have something like that turn out to be a big sham and everything you just said still applies because banks can do it themselves?
Internationally, you could have a sham. You can continue to have that. Tether is currently not bound by the Genius Act. But if I'm a stablecoin issuer bound by the Genius Act and I operate in construction with the regulatory environment, then I should be in pretty good shape. And that's where I think the world gravitates to an infrastructure like the Genius Act that guarantees payment of the coin that you issue.
And those guarantees the Genius Act requires, it's got to have, treasury backed, it's got to have, to some extent, liquid.
93 days is the maximum maturity. It's got to be treasuries or cash. It's actually, if you've got a large deposit, is actually more stable than potentially an insured deposit in a bank.
Fascinating. That's my kind of crypto guy. That's a fun conversation, Bart.
But there is opportunities for banks, and I think banks need to get serious about the strategies they're undertaking, about the futures that they have, and about operating at optimal levels. that's banks right now are operating at suboptimal levels. All banks across the board have to think about how to get to an optimal level of performance.
In theory, if you do something from a defensive standpoint, it can also be an advantage for you as an edge competitively if you do it right.
At a minimum, you need to take a defensive stance. At a maximum, you need to rethink your entire business model and how you've been operating over the last few years, where are your vulnerabilities and how you might change going forward.
Great stuff. Bart, pleasure to meet
you.
Really
Nice to meet
conversation.
you. Thank you.
Yeah, super
pleasure.
Interesting angle. Guess the most sold I've been on a crypto conversation.